Something is disappearing. Not slowly, not gradually, but at a pace that should have every investor, every analyst, and every central banker sweating through their shirt. I'm not talking about a stock. I'm not talking about a cryptocurrency. I'm talking about a physical element. Atomic number 47, silver. For years, this channel has focused on the quiet signals. The data points that hide behind the noise. The numbers that matter when everyone else is watching the wrong screen. And today, I have found a number that stopped me cold. The global above-ground investable supply of silver has dropped by 67%. Not over a decade, not over 5 years. In just 36 months, 2/3 of the available silver on this planet has vanished from the market. And here is what disturbs me the most. Nobody's talking about it. Not the Wall Street analysts, not the financial news networks, not the central banks. The silence is deafening. And in my experience, when powerful institutions go quiet about a crisis, it is because they are the ones causing it. So today, I'm going to walk you through the data. Not the hype, not the speculation, the actual verified numbers from the Silver Institute, the COMEX warehouse reports, the LBMA holdings, and the geological surveys. By the end of this video, you will understand why the silver market is heading toward a crisis that will make the 2020 supply chain disruptions look like a minor inconvenience. Stay quiet, stay sharp, let us begin. Let me start with the headline number, and then I will take it apart piece by piece so you understand exactly what it means and why it matters to your portfolio. According to the Silver Institute's 2024 World Silver Survey, the global silver market has been in a structural deficit for the 4th consecutive year. In 2024, total global silver demand was approximately 1.21 billion ounces. Total mine supply and recycling combined produced approximately 1.1 billion ounces. That is a deficit of roughly 200 million ounces in a single year. Now, 200 million ounces sounds abstract. So let me put it in perspective. Imagine a warehouse the size of a football field, stacked floor to ceiling with silver bars. Now imagine that warehouse losing 20% of its contents every single year with nobody refilling it. That is what is happening right now to the global silver supply. But the headline number, the 67% drop, comes from something more specific. It comes from the COMEX registered inventory and the LBMA reported holdings combined. 3 years ago, in early 2022, the COMEX registered silver inventory. That is the metal specifically available for delivery against futures contracts, stood at approximately 150 million ounces. Today, that number has collapsed to approximately 50 million ounces. That is a decline of 67%. Let me say that again. The metal that is supposed to back the paper promises traded on the most important commodities exchange in the world has declined by 2/3. The vault is not empty yet, but it is draining at a rate that makes a mathematical endpoint not just possible, but inevitable. And the LBMA is no better. London, the traditional home of the global precious metals market, has seen its reported silver holdings decline by over 30% in the same period. The metal is leaving London. It is leaving New York, and it is not coming back. So where is it going? That is the question that should keep every paper silver trader awake at night. And the answer reveals the true nature of the crisis. Silver does not just disappear. It is a physical element. It cannot be deleted or erased. When 100 million ounces leave the COMEX vaults, they go somewhere. And tracking that flow tells us everything we need to know about the future of the price. There are 3 primary destinations for the vanishing silver, and each one tells a different chapter of the same story. Destination number 1, industrial consumption. This is the elephant in the room that most precious metals analysts consistently underestimate. Silver is not just a monetary metal. It is the single most electrically conductive element on the periodic table. It is the most thermally conductive metal. It is the most reflective element known to science. These are not opinions. These are properties of physics. And because of those properties, silver has become absolutely irreplaceable in 3 of the largest growth industries on the planet: solar energy, electric vehicles, and artificial intelligence infrastructure. Let me give you the numbers. In 2020, the solar industry consumed approximately 100 million ounces of silver per year. In 2024, that number has nearly doubled to 190 million ounces. By 2027, conservative estimates from Wood Mackenzie Project solar demand alone will exceed 250 million ounces. Every single solar panel contains between 15 and 20 grams of silver. There is no substitute. Scientists have tried copper. They have tried aluminum. Nothing matches silver's conductivity and resistance to corrosion. When China installs 250 gigawatts of solar capacity in a single year, which they did in 2024, that requires an astronomical amount of physical silver. Electric vehicles are the second drain. A traditional internal combustion car uses approximately half an ounce of silver. An electric vehicle uses between 1 and 2 ounces. As the global fleet transitions, that multiplier effect adds tens of millions of ounces to annual demand. And then there is artificial intelligence. Every data center, every server rack, every high-performance chip uses silver in its connections, its contacts, and its thermal paste. The AI build-out is the most silver-intensive technological expansion in human history, and it has barely started. So destination number one is permanent. When silver goes into a solar panel, it does not come back. It is consumed, it is destroyed as an investable asset, and the rate of destruction is accelerating. Destination number two, the East. This is where the story gets geopolitically interesting. Over the past 3 years, the Shanghai Futures Exchange and the Shanghai Gold Exchange have seen their silver inventories rise, while Western vaults have been drained. This is not a coincidence, it is a strategy. China is the world's largest solar manufacturer. They need the metal, but they are also a strategic thinker on a generational timeline. Chinese state-linked entities have been quietly accumulating physical silver at prices they consider historically cheap. They are not trading paper. They are taking delivery. They are moving metal from west to east. India is following the same playbook. Indian silver imports in 2024 exceeded 100 million ounces, a record. India treats silver as both a monetary asset and an industrial input. Their demand is structural and growing. The net effect is a one-way conveyor belt of metal from the COMEX and LBMA vaults to Shanghai and Mumbai. This is why the registered inventory in New York is collapsing. The metal is physically leaving the country. Destination number three, private vaults. This is the hardest to track, but potentially the most significant. Wealthy individuals, family offices, and sovereign wealth funds are quietly moving silver out of the banking system entirely. They are buying physical bars and storing them in private, non-bank vaults in Switzerland, Singapore, and Dubai. Why? Because they do not trust the counterparty risk of the paper market. They looked at what happened during the nickel squeeze on the London Metal Exchange in 2022, when the LME simply canceled billions of dollars in trades to protect a Chinese billionaire's short position. And they decided that the exchange is not a safe place to hold their claims on metal. So the silver is leaving the system entirely. It is going dark, off the books, unreported. This is bullish because it means the actual available supply is even lower than the reported numbers suggest. Now, the natural response from a mainstream analyst would be to say, well, if silver is in shortage, the price will rise, and higher prices will bring more supply online. It is basic economics. Supply responds to price. In theory, yes. In practice, silver breaks this model completely, and here is why. First, you need to understand something that very few people realize. Approximately 72% of all silver mined in the world is a byproduct. It comes out of the ground attached to other metals: lead, zinc, copper, gold. There are very few primary silver mines on the planet. Most silver is produced as a secondary output of base metal mining operations. This means that silver supply does not respond to the silver price. It responds to the copper price, the zinc price, and the lead price. If copper demand drops and a copper mine reduces production, the silver output from that mine drops too, regardless of whether silver itself is at $25 or $125. This is the structural trap. The price of silver can double and the supply response will be minimal because the mines that produce it are not silver mines. They are copper mines and zinc mines that happen to produce silver as a side effect. Second, even for the primary silver mines, the lead time from discovery to production is between 10 and 15 years. If a mining company discovered the richest silver deposit on Earth tomorrow morning, you would not see a single ounce from that deposit until 2035 at the earliest. Permitting, environmental review, financing, construction. The pipeline is a decade long, so the 200 million ounce annual deficit cannot be solved by new supply. Not this year, not next year, not for a decade. The only thing that can solve it is a price high enough to destroy demand. And given that silver's industrial uses are in sectors that governments are subsidizing, sectors like solar and EVs, the demand is price inelastic. The government is effectively paying companies to consume more silver through green energy subsidies. This creates the perfect trap. Demand is growing and subsidized. Supply is constrained and unresponsive. And the existing above-ground inventory is being drained at 200 million ounces per year. Let us run some simple arithmetic. If the COMEX registered inventory is at 50 million ounces and the annual deficit is 200 million ounces, then the exchange inventory represents approximately 3 months of deficit coverage. 3 months. That is the buffer between an orderly market and a delivery failure. Now, not all the deficit comes directly from COMEX. The deficit is global and is covered by drawdowns from multiple sources: ETFs, LBMA, private stocks. But the direction is unmistakable. Every source is declining simultaneously. There's no cavalry coming. There's no secret stockpile waiting to flood the market. The Silver Institute has been publishing deficit numbers for 4 straight years, and the deficits are growing, not shrinking. The market is not healing, it is deteriorating. And there is a third factor that almost nobody discusses: the declining ore grades. According to data from S&P Global, the average grade of silver ore mined globally has declined by approximately 40% over the past 15 years. This means miners have to move twice as much rock to produce the same amount of silver. Costs go up, energy consumption goes up, environmental opposition goes up, and output stagnates or declines. We are mining the dregs. The easy silver was found and extracted decades ago. What remains is deeper, lower grade, and more expensive to process. This is not a cyclical problem. It is a geological reality. So let me ask the obvious question. If the data is this clear, if the deficit is this large, if the inventory is draining this fast, why is nobody screaming from the rooftops? The answer is both simple and disturbing. The institutions that would normally sound the alarm are the same institutions that benefit from low silver prices. The bullion banks make their money by trading paper silver. They profit from volatility and from the spread between the paper price and the physical price. If the market understood the true supply situation, the price would reset violently upward, and many of those banks would face catastrophic losses on their short positions. The central banks have a vested interest in keeping precious metals prices low because rising gold and silver prices are a vote of no confidence in fiat currency. Every dollar that silver rises is a headline that says your money is losing value. Central banks do not want that headline. And the mainstream financial media depends on advertising revenue from the banks and the brokerages. They're not going to run a segment that says the banks are insolvent due to silver shorts. That is not how the incentive structure works. So the silence is not accidental. It is structural. The people who know are the people who benefit from you not knowing. But the data does not care about incentives. The data does not care about narratives. The data simply is. And what the data is telling us right now is that the silver market is heading toward a physical reckoning. The question is not whether it happens. The mathematics have already answered that. The question is when. And based on the current rate of inventory depletion, based on the acceleration of industrial demand, and based on the inability of supply to respond, the timeline is not years, it is months. So what does an investor do with this information? How do you position yourself on the right side of this equation? First, understand the phases. Based on historical precedent and the current data, I believe we are moving through a predictable sequence. Phase 1 is the quiet accumulation phase. This is where we are now. Smart money is acquiring physical metal. Inventories are declining, but the paper price has not yet fully reflected the shortage. This is the phase where patience is rewarded. Phase 2 is the awakening. This is where a catalyst event forces the market to acknowledge the deficit. It could be a failed delivery on the COMEX. It could be a major industrial buyer publicly warning about supply shortages. It could be a sovereign nation announcing a strategic silver reserve. Whatever the catalyst, it will break the narrative and the mainstream media will be forced to cover the story. Phase 3 is the repricing. This is where the price adjusts violently to reflect the physical reality. In this phase, the paper market and the physical market may decouple entirely. You may see the spot price say one number while dealers are charging a completely different number. The premium becomes the real price. Phase 4 is the new equilibrium. The price settles at a level that either rations demand or incentivizes enough new supply to balance the market. Based on the current deficit and the cost curves of marginal producers, that equilibrium price is substantially higher than where we are today. I'm not going to give you a specific number and pretend I know exactly where silver will trade. That would be dishonest. What I will tell you is that the current price does not reflect the current fundamentals. And when prices disconnect from fundamentals, they always reconnect. Sometimes gently, sometimes violently. The data suggests this reconnection will not be gentle. Let me leave you with this thought. In every market crisis in history, there were people who saw the data early and acted on it. And there were people who waited for the mainstream confirmation and arrived too late. During the housing crisis of 2008, the data was visible in 2006. The mortgage default rates were rising, the CDO structures were mathematically unsound, but the mainstream did not acknowledge it until the collapse was already underway. The people who read the data early and positioned accordingly made generational wealth. The people who waited lost everything. The silver data today is the 2006 housing data. It is sitting in plain sight. The deficits are published. The inventory declines are documented. The industrial demand curves are projected. It is all there for anyone willing to look. The difference between the quiet investor and the crowd is not intelligence. It is timing. The quiet investor reads the data when it is boring. The crowd reads the headline when it is too late. The silver supply has dropped 67%. The deficit is structural. The demand is accelerating. The supply cannot respond. And the institutions that could warn you have every reason not to. You have been warned. Quietly, I am the quiet investor. Stay calm, stay informed, stay ahead. If this analysis brought you value, consider subscribing and sharing it with someone who needs to hear it. I will see you in the next one.